Double taxation is a nightmare of Americans abroad, but it doesn't have to be. So how could Americans avoid double taxation? So let's get into it. So working abroad means you probably have to pay taxes there. And as an American, you also have to file US taxes. So does that mean that you have to get taxed twice? No, and we'll go into some perfectly legal ways to avoid that. First of all, what is double taxation? So the US has a citizenship-based tax system, which means that no matter where you are in the world, you have to file your taxes in American, even if you live abroad, if you meet certain thresholds. And so that does not necessarily mean that you get taxed twice. In fact, there's two things that the US does for US expats. There's the Foreign Earned Income Exclusion, which there's a link to the video here. And here we're going to talk about double taxation, and particularly when it comes to foreign tax credits. Now, I think it's also important to know that even if you're a green card holder, as well as a US citizen, you still need to file. And there are certain filing thresholds which you need to file in order to comply. The Foreign Earned Income Exclusion allows you to exclude up to $130,000 tax-free, and that's of earned income. Now, you could do something where anything over the $130,000 threshold, you could also take as a foreign tax credit. So again, if you're making $200,000, you would exclude the first $130,000, and then the remaining $70K, you would use the foreign tax. Or sometimes you could just choose to ignore the Foreign Earned Income Exclusion and just take the foreign tax credit. So again, this is a decision tree that's based on a lot of factors, such as the tax rate of your local country, as well as the type of income that you have, so on and so forth. And we'll get into that. Now, another aspect to note about double tax is tax treaties and totalization agreements. Now, the US has tax treaty with 69 countries, and the tax treaty is essentially define which country has the right to tax different types of income. So the first question here is, what's better? The Foreign Earned Income Exclusion or the foreign tax credit? Do you do Form 2555 for FEIE or 116 for FTC? Again, different scenarios will ultimately dictate how much tax you have to pay in total. So if you are a higher earner in a place like Singapore that has lower taxes, then you want to go with the Foreign Earned Income Exclusion. If you're a higher earner in countries in Europe with higher taxation, then you want to do the foreign tax credit. Why? Because sometimes you get things like child tax credit in the United States, or even the ability to contribute to a Roth IRA, things that you wouldn't normally be able to get if all of your income was excluded under the Foreign Earned Income Exclusion. However, if you're living in a place like Singapore, where the tax rate is low, roughly 18%, then, even if you're making $130,000, of course, that 18% is not going to cover that whole amount. So you'd rather just exclude the full 130 under the Foreign Earned Income Exclusion. Now, if you're a higher earner in a medium tax country, then you're probably going to do a combination of both. You're going to take the FEIE up to the $130,000 threshold, and then anything over that amount of unexcluded income, you're going to take the foreign tax credit. No double taxation doesn't mean no tax. You'll always have to pay at least as much tax as the USA would levy. So in that example, if one were to make $200,000, the first $130,000 will be tax-free, but anything over that amount, that $70K, will be subject to the foreign tax credit. Now, let's say that person is living in a country like Brazil, where the highest tax rate is 27%. But at $200,000, you're upwards of around 30%. So what does that mean? That means that even if you were to pay the 27% to Brazil, your US tax equivalent would be 30%. So you'd probably have to pay essentially that difference, that 3% difference, to the United States. So there would be sort of a true up, or essentially paying the difference. So I think the big thing is, again, if you live in high tax jurisdictions, you're going to basically pay your tax locally and get the tax credit in the US. If you live in low tax or no tax jurisdictions, you're essentially going to take the Foreign Earned Income Exclusion, and anything over that, you are going to have to pay Uncle Sam the difference. And the only way to not pay US tax when residing in places like Singapore is leaving the US tax system. And what does that mean? That means just renouncing your US citizenship. Although in that case, even income from U.S. sources such as a U.S. pension or U.S. real estate, you would still be taxed by the U.S. if they were U.S. sources, even if you gave up your citizenship. And of course, by the way, we can help with renunciation planning and exit tax optimization. Here's another video that I've done on that, so you can learn more about that. Now let's go into tax treaties. So again, as I mentioned before, the U.S. has income tax treaties with 69 countries, and they're all a bit different. What does the tax treaty do is it really just defines what country has the right to tax certain income. So again, sometimes income is taxed at source where the income's earned, right? So in a case where you have real estate in Spain, even though you might be living in the US, Spain would get the first right to tax real estate in Spain. But if you were living in the United States, of course, the US would tax that first before Spain did if you were, let's say, a dual citizen. The tax treaties also do something called tiebreaker rules, which is important for dual residents because it essentially will dictate whether you pay tax in one country or the other. And a tax treaty does reserve your right to the foreign tax credit, even if you're dual status or even if you're sort of splitting time between two countries. So the tax treaty certainly helps a lot when people have this dual status or dual residency situations, especially when it comes to like resourcing income, etc. Now, the other side of it is something known as a totalization agreement. Now, a totalization agreement is completely different from a tax treaty. A totalization agreement essentially is a tax treaty for Social Security, or really a tax saver. And it's a lot different than tax treaties. In fact, the US has a lot less totalization agreements than tax treaties. So most of the totalization agreements are with European countries, although the US does have a totalization agreement with Brazil and Chile. The big thing is totalization agreements essentially prevent double contribution to retirement systems. So if you are self-employed abroad and you are paying, let's say, tax to Spain, then that means that you do not have to pay into the U.S. Self-employment or Social Security system, or vice versa. So, there are situations where a client is self-employed and they're essentially picking or potentially have the ability to decide which system they will contribute to. Of course, in a lot of circumstances, it really does depend on your residency and how long you're in said country. But the totalization agreement does allow you to potentially be exempt from self-employment tax if you're paying into a local system. The other side of that is that if there is no totalization agreement, there actually might be a situation where you're paying into both. And in that case, it is double taxation. Technically, it's double Social Security contributions, but you are paying twice for said contributions. Now, finally, what are some common mistakes that Americans abroad make with foreign tax credits? One is just forgetting to file the Form 116 and not taking the foreign tax credit. Again, whether it's active income from salary or even passive income from things like dividends or interest, etc. And so forgetting to file Form 1116 is huge. And then the other side of it is not differentiating between what's known as general category income and passive category income for purposes of this Form 116 and the foreign tax credit. Also, not electing the foreign tax credit carry forward. You could either carry forward 10 years or you could even carry it back 1 year. And so making sure that you do that analysis to make that election is super important. And then finally, if you do have a non-US business and you are paying tax locally, then really just optimizing for that business, those business taxes. Again, it could be a 962 election, it could be a check the box election so that said business becomes a disregard entity and it actually goes on your tax return as essentially a Schedule C, and then any business taxes would actually flow and be a foreign tax credit on your personal tax return on that Form 116 under general category income. So again, there's a lot of flexibility and analysis that could be done for foreign tax credit especially to make sure that you are paying double tax, because this can be done and double tax can be avoided legally. If you have any questions, speak to us at Online Taxman, get a consultation. We'll be happy to help. Thank you.